Imagine holding a powerful, yet often overlooked lever in your financial strategy.
Uh-huh.
One that, when you really understand it, could drastically alter how your hard-earned wealth is taxed, how it's preserved, and even how it's gracefully passed down through generations.
It sounds complicated, right? Like something only for the super rich.
Exactly, shrouded in impenetrable legal jargon. But today, right
But
here, right now, we're going to demystify that world, the surprisingly potent realm of trusts and their taxation.
yeah, let's cut through that.
Are you ready to discover how a few key numbers, properly understood, can unlock significant tax savings and truly change everything for your financial future?
Welcome to the deep dive. Our mission today is really to cut through that jargon you mentioned. We'll use our source material to, shine a light on the essential mechanics of trust taxation.
Get right into it.
We'll show you exactly how these powerful entities operate and, maybe more importantly, where the critical tax implications lie.
The tax part is key.
Right. The goal is to equip you with the insights you need to grasp the potential for, honestly, remarkable tax efficiency that trusts can offer, moving beyond the confusion towards, well, clarity.
Absolutely. Think of this as getting the secret decoder ring for one of the most powerful tools in wealth management.
That's a good way to put it.
We're going to break down trusts piece by piece, starting with the very foundation, because trust isn't just a term you hear in legal dramas, right? It's a living, breathing legal structure with very real financial consequences.
Very real.
So let's begin with the basics. What precisely is a trust at its core?
Okay, perfect starting point. At its essence, a trust isn't some nebulous concept. It's a distinct legal entity. It's established under state law.
So like a company is a legal entity?
Sort of, yeah. You can envision it as a carefully constructed, separate legal container. It's specifically designed to hold, manage, and ultimately distribute property.
The container for assets.
Exactly. And its fundamental purpose is deeply personal and strategic.
Yeah.
To benefit one or more specific individuals or entities, we call them beneficiaries, in a structured, controlled way that often goes far beyond what a simple will can achieve.
So it's more than just a fancy bank account then. It's got a plan built in. Rules, purposes.
Definitely.
And every good plan needs key players, right? Who are the main characters in this trust ecosystem that we need to get acquainted with?
Indeed, there are three primary roles.
Yep.
Absolutely essential to understand because they define the flow of assets and, ultimately the tax responsibilities.
Okay.
First, we have the grantor. This is the individual who initiates everything. They're the architect of the trust.
The founder.
The founder, exactly. The person who decides to take their assets, could be cash, real estate, stocks, even a family business, and legally transfer ownership of these assets into this newly created trust container. These transferred assets then become what's formally known as the trust corpus, or principal. The grantor sets the whole thing in motion, defines its purpose, its rules.
So, the grantor is like the founder, provides the initial capital, the vision for what the trust should do. Once they've set it up and funded it, who takes over the day-to-day stuff?
That responsibility falls to the trustee. The trustee is the appointed manager of a trust property. You could call them the steward of the grantor's vision.
The manager got it.
Right. And this role carries significant fiduciary duties. That means they're legally and ethically bound to administer the trust meticulously, following the specific terms laid out by the grantor in the trust agreement.
So they have to follow the rules.
They have to. Their responsibilities are broad. Managing investments to grow the trust's assets, making distributions to beneficiaries, as the trust says, ensuring all legal and tax filings are done, basically upholding the grantor's wishes while following all the laws. They're the operational arm, the trusted hand guiding the trust.
They really are the critical bridge, then, between what the grantor wanted and the beneficiaries getting what they're supposed to get. And speaking of beneficiaries, who exactly are they in this setup?
Finally, yes, the beneficiaries. These are the individuals or entities, could be children, grandchildren, a favorite charity, maybe even a future business venture, who are designated to benefit from the trust's property and income.
The recipients.
The ultimate recipients, exactly. The reason the trust was created in the first place. Depending on the trust's specific terms, beneficiaries might get regular income payments from the trust's assets, or they might receive distributions directly from the trust principal itself. The grantor carefully picks them, and the trustee manages the assets with their best interests at heart.
So grantor the founder, trustee the manager, beneficiaries the recipients. Very clear structure. Now, this is where it gets really interesting for anyone focused on, optimizing their financial future. Once assets are in this container, how do they start interacting with the tax system? Give us that initial glimpse. Where does the tax come in?
This is where the strategic power, especially the tax-saving potential, really comes into view. Once the trust corpus or principal is established, it typically starts generating income annually. Dividends, interest, rent, maybe capital gains.
Okay, standard investment income.
Right. And this is where tax implications immediately surface. The crucial point to grasp, right from the outset, is the pass-through nature of this income. It's not that the trust makes income magically disappear for tax purposes.
Wouldn't that be nice?
Wouldn't it? Instead, each year, this income must be recognized for tax purposes by someone. It ultimately passes through to either the grantor or the beneficiaries. That determines who is responsible for that annual income tax liability.
So the income always finds a home for tax purposes. It doesn't just evaporate.
Precisely. It has to land somewhere.
And figuring out where it lands is the game. This immediately brings us to that fundamental divide in the world of trusts, a distinction that is absolutely paramount for determining your tax landscape, the two broad categories.
Exactly. The single most important classification that dictates who ultimately shoulders the tax bill is whether a trust is categorized as a grantor trust or a non-grantor trust. This distinction is the bedrock. Everything else builds on this.
Let's start by unpacking grantor trusts then. My understanding is these are the ones where the creator, the grantor, still holds a significant degree of control, and because of that, they often keep the tax responsibility too.
You've hit the core principle right there. In a grantor trust, the individual who created and funded it, the grantor, has retained significant powers or interests over the property they transferred.
They didn't fully let go.
Essentially, yes.
Yeah.
The IRS basically says, look, if you still have this much control for tax purposes, we're treating this as if you never really gave it away.
Okay. What kind of control are we talking about?
It can manifest in various ways. Maybe the grantor retains the power to take income back from the trust for themselves. Or they can borrow from the trust's assets without adequate security. They might even hold the power to revoke the trust entirely or change the beneficiaries whenever they feel like it. It's this ongoing substantial control that makes it a grantor trust.
And a really common type of grantor trust, one that many people might actually have heard of, is the revocable living trust, right? How does that fit in?
The revocable living trust is a quintessential example, absolutely.
Wow.
Probably one of the most widely used types of trusts.
Why is it so common?
Many individuals set these up as a sophisticated alternative to a traditional will. Instead of assets going through probate court after death, which could be lengthy and public, a revocable living trust provides a clear, private roadmap for distributing assets.
Avoids probate.
Exactly. And the critical feature that makes it a grantor trust is right in the name, revocable. The grantor maintains full control over the trust assets and the ability to amend, revoke, or completely unwind the trust during their entire lifetime. They can add assets, take them out, change who gets what, even just dissolve the trust.
Okay, so total flexibility for the grantor during their life. If they keep all that power, what does that mean for their tax situation? Does the trust itself file a tax return, pay taxes?
Yeah, this is the pivotal takeaway for grantor trusts, and it offers immediate tax clarity. Grantor trusts are not considered separate tax-paying entities for federal income tax purposes.
Okay, not separate.
Right, because the assets are, for all intents and purposes, still under the grantor's control.
Yeah.
All the income generated by the trust, any deductions it might have, they're essentially ignored by the trust itself for tax filing.
So where does the income get reported?
It passes through directly to the grantor. It's included on the grantor's personal income tax return, their Form 1040.
Even if the money stays in the trust or goes to a beneficiary?
Even then. The IRS views it as if the income was earned directly by the grantor because they retained that control. This definitely simplifies tax reporting for the grantor and avoids the trust having its own separate complex tax calculations.
That's a powerful distinction, simply for the grantor for sure. The legal structure is separate, but for tax, it's still effectively their money. Now let's pivot. The other side. Non-grantor trusts. If grantor trusts aren't separate taxpayers, then non-grantor trusts must be the opposite.
That's precisely the key differentiator. Non-grantor trusts are fundamentally distinct in the tax landscape because they are considered separate tax-paying entities.
Okay, so they do pay their own taxes.
They can, yes. They're required to get their own tax ID number and file their own annual fiduciary income tax returns, usually Form 1041.
Yeah.
The really interesting flexibility with non-grantor trusts, though, is that the income generated can be taxed either to the trust itself or to the beneficiaries.
Uh-huh. So there's a choice there, or at least a mechanism that determines it.
Exactly. And this is where strategic tax planning, especially aiming for tax savings, truly comes into play. The determination of who pays the tax depends on several critical factors. Primarily, how much income is actually distributed to beneficiaries, the specific types of income the trust earns, and a further classification within non-grantor trusts.
And that further classification, that introduces the concepts of simple versus complex trusts, right? What makes a simple trust simple from a tax perspective? Why is that important?
A simple trust, as the name suggests, operates under very clear and strict rules. To qualify as simple, it must meet all three of these requirements every single year. No exceptions.
Okay, what are the three?
First, it must be legally required to distribute all of its income to its beneficiaries annually. No holding back income.
Real income out. Got it.
Second, it cannot, under any circumstances, make distributions from the trust principal, the corpus, during the year. Distributions are strictly limited to the income generated.
No dipping into the main pot.
Correct. And third, it cannot make distributions or contributions to charitable organizations.
No charity gifts from a simple trust.
Right. If a non-grantor trust satisfies all three of those precise criteria, it's classified as a simple trust for that tax year. This predictability often simplifies things for both the trust and the beneficiaries, tax-wise.
So for simple trust, all income out to beneficiaries, no touching principal, no charity. Pretty straightforward. So then a complex trust is basically anything that doesn't fit that very narrow definition.
Exactly. The definition of a complex trust is broad because it's essentially a catch-all. Any non-grantor trust that fails to meet even one of those three strict requirements for a simple trust falls into the complex category.
And that gives it more flexibility.
Significantly more flexibility, yes, which is often why grantors choose this structure. For instance, a complex trust might have the discretion to either distribute or accumulate its income each year. It could also make distributions from the trust principal if needed, or it could be allowed to make charitable contributions.
So it can hold on to income or pay out principal or give to charity. Things a simple trust can't do.
Precisely. And what's really important to grasp is that a trust classification isn't set in stone. Its status can actually change year to year.
Really? How?
Well, a trust could be simple one year if it meets all the rules, but maybe the next year, the trustee decides to accumulate some income or makes a distribution from principal. Boom, it becomes a complex trust for that year. This dynamic nature is a really powerful tool for strategic tax management.
That flexibility is a potential game changer for tax planning because it directly impacts whether income is taxed at the trust's potentially high rate or the beneficiary's potentially lower rate. Now that we understand these fundamental categories, let's get into the numbers. For non-grantor trusts, you mentioned three absolutely crucial calculations that determine who pays what. This is where that hidden lever for tax efficiency really comes into play.
This is indeed the operational core. This is how it all works for non-grantor trusts. As separate taxpayers, they file Form 1041, their own tax return, and they issue Schedule K-1s to beneficiaries to report any taxable distributions.
So the beneficiary knows what to put on their return?
Exactly. And the fundamental principle guiding this whole process, the key to tax efficiency here, is that trust taxable income is taxed once, either to the trust or its beneficiaries, never both on the same income.
Avoids that double taxation.
Critically important. To achieve this, we had this series of interconnected calculations. First, determining the trust accounting income, TAI. Second, calculating the trust taxable income before the income distribution deduction. And finally, establishing the all-important distributable net income, DNI.
Okay, let's unpack these one by one. Starting with calculation 1, trust accounting income, or TAI. What exactly is TAI, and why did you call it the trust's internal scorecard for distributions?
Trust accounting income, TAI, is essentially the trust's book income. Think of it like the income the trustee actually has available to distribute to beneficiaries. It's determined not just by tax law, but primarily by the specific terms written in the trust agreement itself, and also by applicable state law.
So the trust document is key here.
Absolutely. Its primary purpose is foundational. It dictates the amount of income that is required to be distributed to beneficiaries each year, especially for those simple trusts we just talked about. This TAI figure then becomes a key input for the next tax calculations, shaping how much income ends up with the beneficiary versus staying with the trust.
So it's about what the trust can actually pay out as income. And how are different types of income and expenses allocated when we're figuring out this TAI? I assume capital gains are treated differently than, say, dividends.
You're absolutely right. Allocation is critical. Trust income and expenses get meticulously categorized, either allocated to the trust's principal, the corpus, or to accounting income.
Okay.
Most regularly recurring income items, things like operating income, taxable interest, tax-exempt interest, dividends, rent, royalties, those are typically allocated to accounting income. Same goes for most routine operating expenses, including depreciation. Those reduce accounting income.
Makes sense. What about big things like selling an asset, capital gains?
That's the major distinction. Capital gains and losses, which come from selling trust assets, are generally allocated to the corpus or principal.
Why is that?
Because capital gains are usually seen as enhancing the underlying wealth of the trust, growing its foundation, not as regular income meant for annual spending or distribution.
Okay, growing the core value versus providing spendable income. That distinction makes sense. What about trustee fees? They're a significant expense. How do they fit into this TAI allocation?
Trustee fees are a special case, often
Yeah.
flexible. How they're allocated entirely to corpus, entirely to accounting income, or maybe split between the two that's usually dictated by the trust agreement itself.
Well, what if the agreement doesn't say?
Then state law provides default rules.
Right.
But this allocation, how the fees are split, is a surprisingly important detail. It impacts not just the TAI calculation, but as we'll see, later tax calculations too. Let's make this concrete with an example. Let's use the Wells Trust, which we'll say is a simple trust.
Excellent. Let's look at the Wells Trust. One beneficiary. For the year, it generated $3,000 in tax-exempt interest, $5,000 in taxable interest, $5,000 in dividend income, and $10,000 in capital gains. It also paid $6,000 in trustee fees. The trust principal started at $300,000. Now, the trust agreement says trustee fees are split evenly, 50-50, between principal and accounting income. How do we calculate the ending trust principal and, crucially for now, the trust accounting income, TAI?
Okay, let's walk through it. First, the ending trust principal. We start with the beginning balance, $300,000. We add the $10,000 in capital gains since those go to principal, right? They grow the trust's base.
Right, $310,000.
Then we subtract the portion of trustee fees allocated to principal. The agreement says 50-50, so 50% of the $6,000 fee is $3,000. That comes off the principal,
Okay, $310,000 minus $3,000.
which brings the ending trust principal balance to $307,000. See how the capital gain increased the core value, offset slightly by its share of the fee.
Okay, clear for the principal. Now, the trust accounting income itself, TAI, the amount needed for distributions.
Right. For trust accounting income, TAI, we focus on the income sources meant for distribution. We include the $3,000 in tax-exempt interest, the $5,000 in taxable interest, and the $5,000 in dividend income.
That's $13,000 total income.
Correct. From that $13,000, we subtract the portion of the trustee fees allocated to accounting income. That's the other 50% of the $6,000 fee, so another $3,000,
$13,000 minus $3,000.
which gives us a trust accounting income, TAI, of $10,000.
And crucially, because the Wells Trust is classified as a simple trust, this $10,000 TAI is the exact amount that must be distributed to the beneficiary this year. This sets the stage, defines the required payout.
Precisely. TAI is the internal measure of distributable income.
Now let's move to calculation 2. Trust taxable income before income distribution deduction. This number represents what the trust would be taxed on if it didn't get any deduction for distributing income to beneficiaries. Think of it as the trust's gross taxable income before considering that pass-through effect. So this is where we see all the trust's taxable earnings added up, including those capital gains we just allocated to principal for TAI purposes.
That's absolutely right. This calculation includes all taxable income generated by the trust. And crucially, this does include the capital gains from selling assets, unlike in the TAI calculation.
Right.
From this gross taxable income, we then subtract any deductible expenses that relate to that taxable income. But there's a very important nuance here involving tax-exempt income.
Ah, that $3,000 tax-exempt interest we had.
Exactly. That tax-exempt interest income, like from municipal bonds, is explicitly excluded from this calculation of taxable income. And that exclusion has a critical ripple effect on deductions.
A ripple effect. How does earning tax-exempt income impact what the trust can deduct, even for something like trustee fees?
It's a key point for tax efficiency, really. The IRS basically says, if you're earning income we don't tax, you can't deduct the expenses you incurred to get that tax-free income. Makes sense?
Yeah, prevents getting a deduction for earning non-taxable money.
Precisely. So if a portion of the trust's income is tax-exempt, a corresponding portion of its administrative costs, like those trustee fees, becomes non-deductible for tax purposes. You have to allocate the expense.
How do you figure out how much is non-deductible?
You calculate a ratio. You take the non-taxable income divided by the total trust accounting income, TAI, and multiply that fraction by the total administrative expense. That gives you the non-deductible piece.
Okay, so it's a proportional disallowance. That's vital for getting the tax calculation right. What about the trust's exemption? There's a small deduction there too, isn't there?
Yes, trusts get a small statutory exemption when calculating their taxable income. It's modest, but part of the standard calculation. A simple trust gets a $300 exemption. A complex trust gets $100.
Okay, $300 for simple, $100 for complex. Got it. Let's apply this to our Wells Trust again. We need the trust taxable income before income distribution deduction. We know its TAI is $10,000, and we have all the original income and expense numbers.
Let's work through it. First, we need that non-deductible portion of the trustee fees. The Wells Trust had $3,000 in tax-exempt interest. Its TAI was $10,000.
So $3,000 divided by $10,000 is 0.3, or 30%.
Right, so 30% of the total trustee fees of $6,000 is non-deductible. 30% of $6,000 is $1,800. That $1,800 cannot be deducted.
Okay, so the deductible portion of the trustee fees is the total $6,000 minus that $1,800 non-deductible amount. That leaves $4,200 in deductible trustee fees. This is the amount that can reduce the trust's taxable income.
Exactly. Now, we build the trust's taxable income before considering the income distribution deduction. We start with all the taxable income items, the $5,000 in taxable interest, the $5,000 in dividend income, and importantly, the $10,000 in capital gains.
That's $20,000 in gross taxable income.
Correct. From this $20,000, we subtract the deductible trustee fees of $4,200. And finally, because the Wells Trust is a simple trust, we subtract its $300 exemption.
So $20,000 minus $4,200 minus $300.
Which comes out to $15,500. That is the trust taxable income before the income distribution deduction for the simple Wells Trust.
And just to nail this down, if the Wells Trust were complex instead of simple, the only change here would be the exemption amount, right? It'd be $100 instead of $300.
Exactly. The taxable income before IDD would be $15,700 for the complex version, $20,000, $4,200, $200. A small change, but it shows how that simple complex status ripples through.
Okay. Now we arrive at calculation 3, distributable net income, or DNI. You said this is arguably the most crucial, the most powerful limiting factor in the whole framework. Why is DNI so incredibly important? What does it limit?
DNI is significant because it acts as a dual-purpose cap, a ceiling. First, it limits the amount of distributions that are actually included in the beneficiary's taxable income.
Caps the beneficiary's tax hit from the trust.
Yes. And second, it limits the amount of the trust's own income distribution deduction. Remember that deduction the trust gets for paying out income. DNI limits that too.
Okay, so it controls both sides of the equation, what the beneficiary reports and what the trust deducts.
Precisely. Think of DNI as the taxable income funnel. It effectively determines the maximum amount of trust income that can be passed through to beneficiaries and therefore taxed to them at their individual rates. This is absolutely vital for managing who pays the tax. It provides that critical pathway for potential tax savings, shifting income from the potentially higher tax trust to a potentially lower tax beneficiary.
So DNI is the gatekeeper, controlling the flow of taxable income. What does DNI include, and maybe more importantly, what does it usually exclude and why?
DNI is calculated quite differently from both TAI and the trust's gross taxable income. It's designed to be a comprehensive measure, capturing all the economic income potentially available for distribution. So it includes both taxable and non-taxable income, like that tax-exempt interest.
Includes the tax-exempt stuff. Interesting.
Yes, because it's still economic income available to distribute. And it also effectively includes 100% of the trust's administrative expenses before we figure out that non-deductible piece for tax purposes. However, and this is a really significant point, DNI generally excludes capital gains and losses.
Excludes capital gains. Why? TAI didn't include them either, but taxable income did.
Right. The conceptual reason is crucial here. Capital gains are typically allocated to principal, remember. They're seen as enhancing the trust's long-term value, its corpus, not as regular income that's available or intended for distribution to beneficiaries for their day-to-day needs.
Back to that idea of growing the base versus providing spendable income.
Exactly. So to ensure DNI accurately reflects what's truly distributable and thus potentially taxable to the beneficiary, capital gains are usually left out. They typically remain taxed within the trust itself, unless the trust specifically says otherwise.
That distinction for capital gains is huge. They usually stay with the trust and get taxed there. So how do we actually calculate this crucial D&I figure? What's the formula?
The calculation starts with that number we just found. Trust taxable income before the income distribution deduction. From there, you make a series of specific adjustments.
Okay.
You add back the trust's exemption amount, $300 or $100, because that's a tax deduction, not real economic income.
Add back the exemption. Got it.
You subtract any capital gains that were allocated to corpus, because, as we said, D&I generally excludes them.
Subtract capital gains. Okay.
You would add back capital losses allocated at corpus if there were any for the same reason.
Right.
Then you add back any tax-exempt interest income, because DI does include it, to reflect total economic income and determine the character of distributions.
Add back the tax-exempt interest.
And finally, you subtract those expenses that were specifically allocated to that tax-exempt interest. Remember the $1,800 non-deductible piece of the trustee fee. You subtract that here. This ensures D&I reflects the net tax-exempt income.
Okay, that's a few steps. Let's apply this to our Wells Trust one last time to get its D&I. Simple trust version. We know its trust taxable income before IDD was $15,500. Its exemption is $300. Capital gains were $10,000. Tax-exempt interest was $3,000. And we calculated $1,800 of trustee fees were allocated to that tax-exempt income.
Okay, let's calculate the Wells Trust D&I step by step. Start with trust taxable income before IDD. $15,500.
Okay.
Add back the exemption plus $300.
This is $15,800.
Subtract the capital gains allocated corpus.
$10,000.
$5,800.
Yeah.
Add back the tax-exempt interest income plus $3,000.
$8,800.
Subtract the trustee fees allocated to tax-exempt interest.
$18,000.
Result. The distributable net income D&I for the Wells Trust is $7,000.
Wow. Okay, the $15,500 plus $300 minus $10,000 plus $3,000 minus $1,800 equals D&I of $7,000. It's a really significant number. It's much lower than the TAI, $10,000, and trust taxable income before IDD, $15,500. And that big drop is mainly because those capital gains are excluded from D&I.
Exactly right. And that difference is precisely why D&I is so powerful. It sets the true limit on how much of the trust's income can be passed out to beneficiaries as taxable income. Now, with D&I calculated, we can finally move to Part 4, who pays what? Beneficiary and trust taxable income. This is the payoff, where all these numbers come together to show who shoulders the tax bill and how the trust structure can lead to, well, significant tax optimization.
This is where the rubber meets the road, isn't it? The core idea again. Total income generated gets taxed once, either to the beneficiary or to the trust, never both. Preventing double taxation is fundamental here.
It truly is the critical piece. Let's start with the beneficiary side. How is income reported for a simple trust beneficiary? What's the rule for how much income they have to include on their personal tax return?
Okay, for a simple trust beneficiary, the main rule is they must include in their personal income the full amount of trust income that is required to be distributed to them for the year.
Required distribution. Okay.
And that's a key point. It's based on what's required by the trust terms, usually the TAI, not necessarily what they physically received by December 31st. But, and this is where D&I is the star player, this required amount is always capped, always limited, by the extent of the trust's D&I.
The D&I ceiling again.
Exactly. This D&I limitation is critical for tax planning. It puts a ceiling on how much taxable income the beneficiary actually gets saddled with from the trust.
So D&I acts as that vital cap, ensuring the beneficiary isn't taxed on more than the trust's truly distributable sort of net economic income, excluding those capital gains. And when this income passes through, does its original character change? Like, do qualified dividends become ordinary income? Does tax-exempt interest suddenly become taxable?
Excellent question, and often overlooked. Note, the character of each income type, taxable interest, qualified dividends, tax-exempt interest, it stays exactly the same as it passes through to the beneficiary.
That's huge for the beneficiary's taxes.
Absolutely, because different income types are taxed at different rates. Qualified dividends usually get lower rates. Tax-exempt interest stays tax-exempt on the beneficiary's return. Now, if the total amount the beneficiary includes is limited by D&I, then the various types of income, dividends, interest, etc., are allocated proportionally based on their net amounts within that D&I calculation.
Okay, proportional allocation if D&I limits the payout. Let's illustrate this. Daniel Wells, sole beneficiary of our Simple Wells Trust. Required distribution is $10,000, the TAI. We previously calculated trust taxable income before IDD was $15,500, deductible trustee fees were $4,200, and the crucial D&I was $7,000.
Yeah.
So how much income does Daniel report and what's its character?
Okay, first step. Determine Daniel's total income from the trust for tax purposes. It's the lesser of the required distribution, $10,000, or the trust's DNI, $7,000.
Lesser of TAI or DNI for a simple trust beneficiary.
Right, so the lesser amount is $7,000. Daniel's total income from the trust for tax purposes is $7,000. That's the DNI limitation kicking in. He's not taxed on the full $10 TI because DNI was lower.
Correct. Now, we need to characterize that $7,000 for Daniel. We need to figure out how much is dividends, how much is taxable interest, how much is tax exempt. We need those net amounts within DNI. We know the deductible trustee fees were $4,200. Let's assume, for simplicity, they're allocated equally against the taxable interest and dividend income, so $2,100 against each. Okay, $2,100 fee allocation to dividends, $2,100 to taxable interest. And the remaining $1,800 of trustee fees were non-deductible because they were allocated to the tax-exempt interest income. Exactly. So let's calculate the net amounts. Dividend income started at $5,000. Subtract its share of fees, $2,100. That leaves $2,900 net dividend income.
$2,900 dividends.
Taxable interest started at $5,000. Subtract its share fees, $2,100. That leaves $2,900 net taxable interest income.
$2,900 taxable interest. So the total taxable income component within DNI is $2,900 plus $2,900 of $5,800.
Precisely. And the tax-exempt interest started at $3,000. Subtract the $1,800 fees allocated to it. That leaves $1,200 net tax-exempt interest income.
$1,200 tax exempt.
Now check. $2,900 dividends plus $2,900 taxable interest plus $1,200 tax-exempt interest equals $7,000. That matches our DNI calculation. So Daniel's $7,000 of income from the trust consists of $5,800 that is taxable to him as dividends and interest and $1,200 that is tax-exempt.
Perfect. This shows exactly how the simple trust, limited by DNI, passes through specific types of income directly to the beneficiary. And Daniel potentially benefits if his personal tax rates on that $5,800 are lower than the trust rates would have been.
That's the potential tax optimization right there.
Okay, clear picture for simple trusts. What about a complex trust beneficiary? How does that differ, given complex trusts have more flexibility?
For a complex trust beneficiary, the core principle shifts slightly, but it's still fundamentally tied to DNI. Here, the beneficiary includes in their income the taxable amount of distributions they actually receive during the year.
Actual distributions received, not required distributions.
Correct. That's the key difference. However, that amount they include is also limited by DNI. DNI is still the ceiling.
Still capped by DNI. Okay.
Right. The emphasis is on actual discretionary distributions rather than required ones. Just like simple trust, the income character preservation rule applies, dividends stay dividends, etc. And if the amount included is limited by DNI, it's allocated proportionally based on the net income sources within DNI, just like we did for the simple trust beneficiary.
Let's switch our scenario then. Daniel Wells, but assume the Wells Trust is now a complex trust. Same income, $3K tax exempt, $5 taxable interest, $5 dividends, $10 co-capital gain, and expenses, $6K fees. Now it's complex, so the exemption is $100. The trust taxable income before IDD is $15,700. DNI is still $7,000. Only the exemption changed in that calc. But this time, the trustee of the complex trust made a discretionary distribution of only $5,000 to Daniel. How does this play out for Daniel's tax bill?
Okay, Daniel's income from the trust for tax purposes is the lesser of the actual distribution he received, $5,000, or the trust's DNI, $7,000.
Lesser of actual distribution or DNI.
Right, so the lesser amount is $5,000. Daniel's total income from the trust for tax purposes is $5,000. Now, we need to proportionally allocate this $5,000 across the different income types using the character and net amounts within DNI.
We already figured out the net amounts in DNI. $2,900 dividends, $2,900 taxable interest, $1,200 tax-exempt interest, total DNI $7,000.
Correct. Now we need the percentages within DNI.
$2,900, $1,000, roughly 41.4%.
$2,900, $7,000, roughly 41.4%.
Okay, about 41%, 41%, and 17%. Those add up to 100%.
Yeah. Now we apply these percentages to Daniel's actual $5,000 distribution.
41.4%, $5,000, $2,070. Taxable interest portion, 41.4%, $5,000, $2,070.
So Daniel's total taxable income from this complex trust distribution is $2,070 plus $2,070 plus $2,070, $4,040.
Exactly. And the tax-exempt portion, 17.2%, $5,000, $860.
Let's check. $2,070 plus $2,070 plus $860 equals $5,000. Matches his distribution. Perfect. So in this complex trust scenario, Daniel reports $4,140 of taxable income and receives $860 tax-free. Notice he reports less taxable income, $4,140, than in the simple trust scenario, $5,800, simply because the trustee chose to distribute less, $5,000 versus $10,000 required.
This really highlights how discretionary distributions, combined with that D&I limitation and proportional allocation, directly dictate how much taxable income flows to beneficiaries. The trustee's decisions, guided by the trust document, become a powerful tool for tax optimization, especially comparing the beneficiary's tax bracket to the trust's.
Absolutely. And that brings us to the final piece. The income distribution deduction, IDD, and final trust taxable income. This is how the trust itself gets credit for the income passed out, completing that single taxation principle.
So the core purpose of this IDD is flat out preventing double taxation, right? Making sure income isn't taxed once to the trust and then again to the beneficiary.
That's the fundamental reason it exists. It's a direct tax-saving mechanism built into the system. Trusts receive a deduction for the taxable distributions they make, or are required to make, to beneficiaries. The amount of this income distribution deduction, IDD, is exactly the same as the taxable amount of trust income that was attributed to the beneficiaries.
So it perfectly offsets the taxable income passed through.
Exactly. It ensures every dollar of taxable income generated by the trust is taxed only once, either to the beneficiary or to the trust, never both. This maintains fairness and prevents excessive tax burdens.
So if the beneficiary is taxed on it, the trust gets to deduct it. Makes perfect sense. What's the straightforward formula then for the trust's final taxable income, the amount it actually pays tax on?
It's quite simple once you have the previous numbers.
Yeah.
You take the trust taxable income before the income distribution deduction, that figure from calculation 2. Then you subtract the income distribution deduction, IDD itself, which is the taxable amount passed to beneficiaries. The result is the trust's final taxable income for the year.
Okay, let's apply this to our simple trust example first. The Wells Trust as a simple trust. We found its trust taxable income before IDD was $15,500. And Daniel's taxable income from the trust, which is the IDD, was $1,500.
Right. So the trust's final taxable income is $15,500 minus the $5,800 IDD. That equals $9,700. This $9,700 is the amount the Simple Wells Trust itself will pay taxes on.
And you mentioned earlier, for a simple trust, this often aligns with the capital gains minus the exemption. Let's see, $10,000 capital gain minus the $300 simple trust exemption. Yes, that's $9,700 too, because all the other taxable income, $5,800 net, was effectively pushed out to the beneficiary via the required distribution and IDD.
Precisely. The Simple Trust typically ends up paying tax only on its retained capital gains, less its small exemption.
Okay, now finally for our complex trust example. When the Wells Trust was complex, its taxable income before IDD was $15,700 due to the $100 exemption. And Daniel's taxable income from that trust, which becomes the trust's IDD, was $4,140 based on the $5,000 discretionary distribution.
Correct. In this complex trust scenario, the income distribution deduction, IDD, is $4,140. So we subtract $4,140 from the $15,700 trust taxable income before IDD.
$15,700 minus $4,140.
That leaves the complex Wells Trust with a final taxable income of $11,560.
Wow. Okay, this is where that hidden lever for tax optimization really becomes clear. Let's compare. The simple trust had a final taxable income of $9,560.
A difference of almost $1,900 more taxable income staying within the complex trust.
And this is critical because trust tax brackets are notoriously compressed, right? They hit the highest federal tax rates much faster than individuals do.
Absolutely critical. In 2024, for example, a trust hits the top federal tax bracket, 37%, with taxable income just over $15,000. An individual filing single, on the other hand, needs taxable income over $600,000 to hit that same 37% rate.
That difference is staggering. So the decision by the trustee of a complex trust to accumulate income versus distributing it isn't just about managing cash flow for beneficiaries. It's a profound strategic tax choice.
It absolutely is. Does it make more sense for the trust to pay tax at its potentially very high compressed rates on that $11,560? Or would it have been better overall to distribute more income up to the D&I limit to Daniel, assuming he's in a much lower individual tax bracket, thereby significantly optimizing the total tax paid by the trust and beneficiary combined?
That flexibility, guided by understanding TAI, D&I, and the IDD, is invaluable for sophisticated wealth planning, especially across generations. It truly underscores how trusts, particularly complex ones, can be incredibly powerful tax-saving vehicles when managed strategically.
Exactly. It's not just about legal structure. It's active tax management.
So whether it's a simple trust diligently distributing everything it earns or complex one strategically holding on to some gains, understanding these calculations, TAI, taxable income before IDD, D&I, beneficiary income, IDD, it's far more than just crunching numbers.
It really is.
It's about knowing precisely how wealth flows through that trust container and exactly where those tax implications land. This deep dive, I think, clearly demonstrates that even within these seemingly intricate legal structures, there's a clear, logical framework to follow.
A framework that empowers you, the listener.
Right, empowering you to grasp the true financial impact and potentially unlock that strategic tax management potential we've been talking about.
Indeed. So thinking about all this, what part of trust taxation do you find most intriguing now that we sort of pulled back the curtain?
Good question for our listeners.
What new questions does this raise for you about managing assets for the future? Maybe especially concerning that flexibility of non-grantor trusts and the potential tax implications. We definitely encourage you to keep exploring, keep asking those big what-if questions,
And maybe talk to a pro.
and perhaps even consult with a qualified tax or a legal professional to see how these principles might apply or could be optimized for your own unique financial situation.